Every market crash feels sudden, but it is never random. When prices fall sharply, the damage is uneven. Some stocks collapse by 50, 60, even 80% and never fully recover. Others decline, sometimes significantly, but regain their footing, recover earnings, and go on to make new highs. The difference is not luck, timing, or intelligence. It is structure. In 2026, after years of volatility, tightening financial conditions, and repeated shocks, understanding why some stocks survive crashes while others fail is no longer optional. It is the core skill of long-term investing. To understand how to pick stocks that do not collapse in a crash, we must first understand what actually causes collapses. Market crashes are not simply price declines. They are moments when confidence evaporates, liquidity dries up, and investors suddenly reassess risk. In these moments, stocks fall not because investors dislike them, but because they must sell. Margin calls are triggered. Debt becomes harder to roll over. Cash becomes scarce. When this happens, companies with weak financial foundations are exposed immediately. Companies with strong foundations bend, but do not break. History is instructive here. During the 2000 to 2002 dot-com collapse, the Nasdaq fell nearly 80% from peak to trough. Thousands of companies disappeared. Yet businesses with real earnings, such as Microsoft and Intel, survived and eventually recovered. During the 2008 financial crisis, banks with excessive leverage collapsed or required bailouts, while companies with strong balance sheets and global demand recovered faster. In 2020, when markets crashed during the pandemic, companies dependent on constant revenue flow without cash buffers were wiped out, while firms with liquidity and adaptable business models emerged stronger. The pattern is consistent across decades. The first principle of crash-resistant stock selection is simple but often ignored. A company must be able to survive without access to external capital. In crashes, capital markets shut down. Equity issuance becomes punitive. Debt refinancing becomes expensive or impossible. Companies that rely on constant borrowing or equity raises are structurally fragile. By contrast, companies that generate sufficient free cash flow to fund operations and investment internally are far more resilient. In 2026, this principle is more important than it has been in over a decade because interest rates are no longer near zero. Debt is no longer free. Free cash flow is not a buzzword. It is the difference between survival and failure. A company that generates steady free cash flow can pay suppliers, service debt, invest selectively, and reassure investors even during downturns. Data from past crises shows that companies with positive free cash flow going into a recession experience materially smaller drawdowns than companies burning cash. More importantly, they recover faster. When evaluating a stock in 2026, the question is not whether revenue is growing quickly, but whether cash is real, recurring, and defensible. The second critical factor is balance sheet strength. Crashes punish leverage brutally. A company with high debt relative to earnings is not merely riskier. It is structurally unstable. Rising interest rates magnify this risk. A firm with debt equal to 5 or 6 times earnings may appear manageable during good times, but becomes vulnerable when earnings decline or refinancing costs rise. In contrast, companies with conservative debt levels, long maturity profiles, and fixed interest costs are insulated from short-term financial stress. Historically, companies with net debt below 2 times EBITDA experience significantly lower bankruptcy risk during downturns. Balance sheets are not just about debt levels. They are about flexibility. Cash reserves provide optionality. Companies with liquidity can endure temporary revenue shocks, maintain investment in core operations, and even acquire distressed competitors. During crashes, optionality is priceless. In 2026, after years of elevated volatility, investors increasingly reward companies that treat liquidity as a strategic asset rather than idle capital. The third characteristic of crash-resistant stocks is stable demand. Some products and services are discretionary. Others are essential. In downturns, consumers delay vacations, luxury purchases, and upgrades. They do not stop paying for electricity, healthcare, insurance, or basic communication. Companies serving essential needs experience less revenue volatility during crashes. This does not mean their stock prices are immune to declines, but it does mean their earnings base remains intact. Over time, Earnings stability anchors valuation. Pricing power is closely related. A company with pricing power can protect margins even when costs rise or demand softens. This often comes from brand strength, switching costs, regulatory protection, or network effects. During inflationary or recessionary periods, companies without pricing power see margins collapse. Those with pricing power adjust prices and maintain profitability. In 2026, with cost pressures still present in many sectors, pricing power is a key differentiator between resilience and collapse. Another overlooked factor is business complexity. Complex business models often hide risk. Companies with opaque accounting, aggressive adjustments, or reliance on one-time gains are difficult to evaluate under stress. When markets are calm, investors tolerate complexity. During crashes, complexity becomes suspicion. Transparency becomes a form of safety. Firms with simple revenue models, clear cost structures, and understandable economics retain investor trust when confidence is scarce. In crises, trust has value. Sector dynamics also matter. Certain sectors are structurally more vulnerable to crashes. Highly cyclical industries, such as discretionary retail, construction, or speculative technology, experience amplified downturns. This does not mean they should be avoided entirely, but they require stricter selection criteria. Within any sector, the strongest firms survive while weaker ones disappear. The goal is not to avoid volatility, but to avoid permanent impairment of capital. Valuation plays a crucial role in crash resilience. Even the best company can suffer severe declines if purchased at an extreme valuation. When expectations are high, disappointment is punished disproportionately. Stocks trading at excessive multiples assume flawless execution. Crashes expose reality. Historically, stocks trading at modest valuations relative to earnings and cash flow experience smaller drawdowns during market stress. In 2026, valuation discipline is not conservative. It is pragmatic. Another key factor is shareholder structure. Companies dominated by short-term traders, speculative investors, or leveraged holders experience more violent sell-offs during crashes. By contrast, firms with long-term institutional ownership and stable investor bases exhibit more orderly price behavior. While individual investors cannot control ownership, they can observe it. Stability in ownership often reflects confidence in the underlying business. Geography and currency exposure also influence crash behavior. Companies with diversified revenue streams across regions are less exposed to localized economic shocks. Firms heavily dependent on a single market or currency face concentrated risk. In a world where geopolitical uncertainty remains elevated, diversification is a form of resilience. In 2026, technology deserves special mention. Technology stocks were once treated as uniformly high risk during downturns. That is no longer accurate. The distinction is between speculative technology and essential technology. Companies providing infrastructure software, cybersecurity, cloud services, and enterprise systems are now embedded in daily operations across industries. Their revenues are recurring, their switching costs are high, and their demand is persistent. These firms behave more like utilities than startups. Conversely, unprofitable tech companies dependent on future promises remain highly vulnerable. Dividends and shareholder returns also contribute to crash resistance. Companies that return capital consistently signal confidence in their cash flows. Dividends provide tangible returns even when prices decline. Over long periods, dividend-paying stocks have demonstrated lower volatility and stronger recovery profiles than non-dividend payers. In 2026, income is not a secondary consideration. It is a stabilizing force. One of the most important mindset shifts investors must make is to separate volatility from risk. Volatility is visible. Risk is permanent loss of capital. Crash-resistant stocks can be volatile. Their prices may fall sharply in panic, but their businesses endure. Over time, prices follow earnings. Investors who understand this distinction avoid emotional decisions during downturns. Ultimately, picking stocks that do not collapse in a crash is not about predicting the crash itself. Crashes are unpredictable in timing and trigger. It is about preparing for inevitability. Economic cycles have never been eliminated. They have only been delayed. In a world where leverage, complexity, and interconnectedness remain high, future shocks are certain. The question is not whether they will occur, but how your portfolio will respond. In 2026, the stocks that survive crashes share common traits: strong cash generation, conservative balance sheets, essential demand, pricing power, transparency, reasonable valuations, and discipline management. These are not exciting attributes. They are durable ones. Investors who focus on these characteristics are not immune to market declines, but they are protected from ruin. The lesson history teaches repeatedly is simple. Markets recover. Companies that endure recover with them. Those that rely on hope do not. Picking stocks that don't collapse in a crash is not about avoiding pain. It is about ensuring that pain is temporary. And in investing, that distinction makes all the difference.